Hello. Well, certainly here in Australia today, we're expecting the ASX 200 to open modestly lower, probably down about 13 points or so. Pretty difficult to work out where we're going to see the big moves today. Certainly there has been some moves higher in the energy space, and that may be reflected today. But really there's only one thing that people are talking about, and that's the moves in the currency markets. The moves certainly driven by what we saw from the Swiss National Bank, which was absolutely breathtaking last night. We will not see moves like that again in our lifetime, and certainly that's really what traders are talking about. And one of the ramifications of the moves from the Swiss National Bank last night, there was no way anyone expected what we saw from the Swiss National Bank to remove the 120 exchange rate target. If you look at Bloomberg, for example, they surveyed 22 economists recently. Not one single one of them was expecting that exchange rate floor to be removed this year, and only 4 of them were expecting that to be removed next year as well. If you look at the futures market, if you look at the Commitment of Traders report, which comes out every week and looks at the CFTC data, the market, or the hedge fund community, the speculators were actually net long about 24,000 contracts of dollar Swiss franc, which was the highest level since mid-2013. It shows that the big moves that we saw last night in dollar Swiss downwards following the euro Swiss was really premised also on some really big pain being felt in the hedge fund community. We would have seen some big margin calls through there. That would have exasperated the moves lower as well. But certainly no one was expecting that. And certainly when you hear comments from the Vice President of the Swiss National Bank last week, they're going to do their utmost to defend the floor, you really didn't expect to see that. And certainly price was there for everyone to see. And of course, as I say, the moves were fairly breathtaking last night. So, you know, the Swiss National Bank themselves have a history of defending the euro Swiss, and certainly the Swiss franc in general. During the 1970s, they looked to defend and intervene against the German mark. You know, up until 2010, we'd seen them directly intervening in the forex market. In 2010, they actually said that they made a book loss of about 19 billion Swiss francs. They stopped doing that. Certainly speculators enjoyed that every time they intervened in the market and caused the Swiss franc to weaken. You know, they just came out and jumped on that and bought it again. On obviously September 2011, that's when they put the peg in place. So certainly what we've been seeing was not expected by the market. It's going to have big ramifications across currency markets probably going forward for the next couple of months. You know, there's been a big loss of confidence in the Swiss National Bank, and we can go from here. So they've imposed as a countermeasure to that removal of the floor, which they did effectively because they saw a massive rally in dollar Swiss and they thought they had license to do so. But they've imposed 75 basis points of negative deposits. So they're charging banks now 75 basis points to leave money with their sight deposits. Now that will drive some money away from the Swiss banking sector, and they'll move that money perhaps into the Bank of England. Maybe they'll move that money into the Fed and other jurisdictions around the world, and that will cause some capital outflows, or at least, you know, weaken that currency to a degree, which we still think the Swiss franc is modestly overvalued at the moment. But certainly what we're seeing is a counter move there. If we look at the bond market in Switzerland, for example, we've got negative real rates, we've got negative interest rates right out to 7 years, and the 10-year Swiss government bonds now only trading at 4 basis points. So effectively, you know, the Swiss National Bank can go and borrow, or the Swiss government can borrow for 10 years and only pay 4 basis points, which is pretty crazy. And I think that's thematic around some of the other developed markets as well. We're seeing ultra low yields coming through. But certainly we're seeing some buying coming through in dollar Swiss. I think we're seeing some strategists recommend that position. That could be one that you could look at going forward from what we've been seeing, given that the Fed are going to look to raise next year. And we are going to see the Swiss National Bank continue to intervene and calm volatility in the short term. So that may see some flows. But certainly what we saw last night was absolutely breathtaking. And we're really, you know, shows not just a stamp of approval on the rally that they've seen in dollar Swiss, but also their view that they really don't have any choice. If you look at the balance sheet of the Swiss National Bank, the assets they've accumulated from sitting on the bid at 120 is around about 85% of GDP now. That is not sustainable. They cannot continue to buy euros and accumulate that through other currency reserves for any longer period of time, especially if the ECB likely to announce a quantitative easing program on January 22nd, which will grow in stature as the year goes on. And they've basically said that they just cannot continue to accumulate euros and then recycle them into other currencies as well. It's just not sustainable, and that will just end in tears as well. So they really were stuck between a rock and a hard place, but massive ramifications across the currency markets, massive volatility likely to continue as a result of this.